Now we have our Dealmaker panel.
Well, hello everyone. I'm Sima Griffith. I'm a co-founder of Aethlon Capital. We're a boutique investment bank, and we sell privately held companies that have between 20 million and 200 million in revenues.
My name is Kam Kielhorn. I'm a principal at Tonka Bay Equity Partners. We are a private equity group based here in Minnetonka, Minnesota, and we just celebrated our 25th year of being in business, which we're proud of.
My name is Gergen. I work with Carlson Private Capital Partners. We are only 5 years old. I can't wait till we're 25 years old. But we were formed 5 years ago from the capital from the Carlson family.
We've all had our experiences with the hot, maybe warm 22 market, and now we're experiencing 2023. I'm curious to know what maybe has caused the cooling of the market here more locally, regionally.
It's a pretty trepidatious impact of the regional banking and the broader banking and financing markets. I think there was at least relative to maybe 6 months ago, there's a little bit more activity that's starting to come back. But because the financing markets have been so choppy over the past few months, it's definitely more difficult to get a deal done. And so everything is taking longer.
I think what's really changed are interest rates. So if you rewind back to March of 2020, interest rates were 0.25%. Fast forward to today, and interest rates, the Fed funds rate is between 5 and 5.25. And so those higher interest rates and the higher cost of capital is really causing a downturn.
I think a lot of it is relative also. I mean, we're coming off of like the two greatest years of M&A activity valuations ever. So if you look at this over a longer time frame, 2023 is still good. I don't think things are as bad as what the news cycle would lead you to believe. I mean, companies performed really, really well in 21 and 22 for a couple of reasons that we can talk about. Companies performing well lead to higher valuations, more M&A activity, pretty simple drivers.
Let's talk about the length of the deal process.
Because there's more uncertainty in the market, maybe there's a recession looming Q4 23, Q1 of 24, and the buyers perceive more risk, they're doing more due diligence. So I'd say that's added 60, 90 days to closing.
As a plus side, because it's not all negative, it does allow for a lot better evaluation of the cultural fit between the buyer and seller.
You're right, it's the cultural fit. Even if you get something signed up under exclusivity for an LOI, having 90 days to figure out who you're going to be partnering with for the next 5 years for us and longer for you, that's really important time.
Let's stay with deal structures. We've just come off due diligence. As we look at current deals compared to maybe a year ago, are there changes in deal structures?
We're definitely seeing some more openness to earnouts or structure. We're also seeing over-equitizing.
Well, no one loves earnouts really on either side, but they're a tool to be used. I think the reason they're becoming more prevalent now is for two reasons. One, if last year you look back and you said, well, I think I could have sold my company for $100 million and now it's probably worth 80, it's really hard to move past what you could have, should have. Timing's everything. So you'll never forget about that, and you have that in your head, so you're trying to bridge that gap. The other thing is just the trends of the last 36 months are very difficult to make heads or tails of.
I'll just say, in all my years of doing deals, we've done earnouts twice. And the reason we did them was the second half was going to be better than the first half. And our clients said to us, why do we need to close in June? Our second half is going to be fantastic.
And you said time is not your friend.
And I said, time isn't your friend. So we've done earnouts twice, and it's worked out really well for our clients.
Could you explain maybe a little bit more about your business models, family office versus private equity? And what's the ideal seller look like for you?
For us, it's a founder or a family that is looking at, they have a great business, but they're looking at taking some chips off the table and changing the risk profile to continue to accelerate growth.
The difference, the distinction is we do raise pools of capital that have investors contributing capital that have a long-term vision. They understand this is not a liquid investment. They can't buy and sell the stock. They're 10 to 12-year funds historically in private equity. So there is a long-term investment horizon, but there is a endpoint to that. So our average investment period is 6 to 7 years. And so what makes a good seller to us is a founder who wants to find a good cultural fit, and their time frame aligns with ours.
And in the end, we tell our client, you get to choose who you marry. And some of them like the family office approach because it's longer term. They'll hold for 10 or 20 years, slow and steady. Whereas the private equity will typically resell their company in 5 to 7 years. And mostly what I'm seeing is they are not doing deals with strategic acquirers because most of our clients want to take care of their employees, and they know that the strategic's going to get rid of the CEO, the CFO, the head of HR. So they tend to be the least favored buyer of our clients.
What's a good investment banker?
Number one criteria is experience. And, I've been doing deals and my colleagues for close to 30 years, so we've seen a lot. And some of the big investment banks, they bring in the senior guys to sell the business owner. And then once the business owner signs the contract, the senior guys disappear. And
Thinking of the end of 23, 24, what's your outlook?
But overall, I think that at least for where we focus from a founder-seller perspective, there's been a lot that's happened over the past few years that's really exhausted a founder in terms of the mental load that they carry to own and grow and invest in their business. There are a lot of founders that are just ready to share that burden and bring on an investment partner. And for that reason, I'm optimistic about the next 12 months.
It seems like we're going to just keep plugging along at this kind of same pace.
if the Fed continues to increase rates, I was so relieved 2 weeks ago when they didn't hike them up, but they're talking about 2 potential rate hikes for the rest of the year. That's going to slow things down.
I'd like to thank all of you for taking time out of your day to be here, and I'd like to thank my panelists for taking the time working with me and going off script once or twice, not too bad. But thank you for your time and participation.